It's Joe Gleason and Tom Gleason. We are the Prosperity Brothers. Here it is on November 10th, 2022, and we're putting together this video today to talk about a few things that are happening in our economy, things that are happening. Just kind of, we won't touch too much on world events, but we just had a midterm election, so a lot going on, both politically, economically, and in all areas. But I just like to say that it's not often that I here in Phoenix have colder weather out than you do in the Chicago area. So a lot of weird things going on. There's all the things going on in the economy and politics, and then also just the weather, right? So
yeah, this time of year to have 70+ degree weather is I'd say pretty rare. So
for you, that's normal. We call that normal.
Exactly. Yeah,
awesome.
I want to start out by saying most folks will be watching this in the next day or two. So happy Veterans Day to all the veterans, everybody who served, past, present. Just our respect and appreciation for your service, and thank you.
Absolutely, I second that. Our dad was in the Army during Vietnam. Our grandpa was in the Navy during World War II. So definitely want to say thanks to all you veterans and appreciate what you do. So cool. And it's Remembrance Day in Canada. So if anyone in Canada is watching, then happy Remembrance Day there. So awesome.
I forgot that it was Remembrance Day. No.
You see what you did there.
Moving on.
So I also wanted to say that since I did not win the 1.6 billion Powerball, I am here to do the video here with you. Otherwise, I'd have been on an island, probably hanging out with you and our families on an island with a drink with an umbrella. So here we are, back doing another Pro Bros. The Prosperity Sisters may have one. We'll have to check in with them. So.
Exactly. We haven't heard from them. What's going on? They might have won.
They've been pretty quiet. They've been pretty quiet.
They spent some time in California. That's where the winning ticket was, as I understand it. So
yeah, yep. All right, so let's just recap what we did last time. We did a video a couple weeks ago, and we talked about the perfect storm, what's going on more economically. But just to kind of quick recap that, some of the things we talked about were is this kind of convergence of a lot of sort of big things happening in the world of market volatility, not only the stock market, but the bond market, the real estate market, et cetera. So there's market volatility. The IRS has recently put a headline out there that they're hiring 87,000 IRS agents, improving software. And we're speculating that that's not to give us all bigger refunds and better deductions. We're guessing that that's probably going to impact revenue that they're seeking, right? And so then also 40-year highs on inflation, and that the interest rates have been continually raised, and that the Fed has made it their policy that they're going to continue to raise the rates. So it's not like there's any short-term news that that's going to change. And then also a lot of things happening geopolitically, all the things that are happening with Russia, Ukraine, et cetera, and beyond. I mean, we've got the North and South Korea. So just things everywhere, Europe. Yeah. So that's kind of a recap of what we were talking to folks about. And so jump on in, Tad, and you can.
Well, we talked last time about the market being off, and that continues to show a lot of volatility. So we're up big one day, down big the next day. There's a lot of concern that my clients are coming in with regard to that. When you talked about the interest rates on your intro, I think that affects the bond market. So if you can explain a little bit more, I know if history is our guide in any way, with Powell coming out or the Fed coming out in general and saying that they're going to continue to raise interest rates as a hedge to inflation, that will affect the bond market inversely because, if you can get new bonds for a higher interest rate than the older bonds that are lower interest are tougher to sell, et cetera.
So then you have to discount the cost of the bond to make it worthwhile to offset the would-be interest that you would earn on the. Okay, so let's do this another way, right? So if you go, let's say a couple of years ago, and I'm just going to use generic numbers. These are not absolute numbers. I just want to try and keep the math simple and just kind of get the concept here. Let's say 2, 3, 4 years ago, you went out and bought a government bond. We'll just use like U.S. bonds because there's government bonds, and there's also corporate bonds, and so let's keep it kind of simple with things that people know about. So let's say someone goes out and buys a U.S. bond and it's paying 2% a couple years ago. So let's say someone invests $100,000, they have a 2% bond, and they get their $2,000 a year interest, right?
Hmm.
And then today, because interest rates have been going up, so the that and a bond is debt, right? So it's an IOU,
Hmm.
so rates are going up. So let's say a person today goes out and buys a bond and says, "I'm going to take $100,000. I'm going to get 4% on
Hmm.
that bond in today's economy." And so now I'm making $4,000 a year of interest, but then the person A says, "Wait a minute, I need this principal. I don't need to sell out of this bond." So what do they have to do to make? Because nobody would buy a 2% bond if they can go on the street today and get a
Right.
4% bond. Like, why
With
would
the
you do
same
that?
terms, you're getting a 4%. You have to do something to sweeten the pot.
Yep. So in order to do that, you reduce your you basically have to you reduce the principal essentially, right? So it's so you have to discount the bond to make it so that you can sell it, right? So and you um yeah, so long story short, that's kind of the quick simple answer.
Sure. And if we look
And
at
so
that, like we talked about cycles last time, and how if we think or are possibly preparing for a 100-year cycle, which was the 1929, 1932, we talked about the stock market, which everybody's aware of. And that's the main thing we think about when we think about the stock market crash, which led to the Great Depression. When things really got bad was not until the early 30s. I think it was 32 when the bond market really started to wobble and fall off. So that's when the
yeah,
depression really deepened and made it the long-term,
yeah,
decade-long issue that it became. So
exactly. So
that's why we're concerned with it is
and so part of this is like that you look at there's more micro cycles, and then there's sort of mid-range cycles, and then longer term cycles. There's a really interesting book called the fourth turning, and it's by William Strauss and Neil Howe. It's not a financial book. It's more about just like bigger world events, and then of course financial issues happen within that. That's part of what we all deal with is economies and markets and so forth. So in that, the fourth turning is kind of like where things shake loose a little bit more than
right.
I'm not trying to scare
Upheaval and
people.
right.
We
No,
do want
it's
to ultimately be positive, but we also want people to be empowered and not be
well, it's like
made
seasons.
aware of.
So these turnings are spring, summer, winter, fall, and winter. And
Right.
in order to have healthy springs and summers, we need to have occasional winters, which is
Right.
what we are discussing. Is that it's, to my way of thinking, becoming more and more apparent that we're getting into a
The fourth
winter,
turning.
the fourth
Yeah.
turning, with not just a financial winter, but really in a lot of sense, just society in general. So, how do we
Right.
prepare for that? Because that's when opportunities really, that there's a lot of opportunities if you're properly prepared for
Yeah,
that.
and on the other side of that is then the sort of like the when things like can restart. I mean, we're both from Illinois. You're still there, and I remember hearing about having to burn the prairie
Mhm.
so that then the new growth can come in and it's bigger, better, stronger, faster, etc. And so it's kind of metaphorically the idea here is that there's going to be a reimagining of a lot of societal things, with the emergence of new technologies, with awareness of more global markets, with just all kinds of things geopolitically. So that's what I know we're kind of going off script here a little of the economy and market specifically, but it does happen more macro than just, hey, it's the U.S. stock market that goes up and down,
Well, it's
or the
important
U.S.
as
tax code, right?
my thought is, as the way my philosophy as a planner, and I think it is yours too, is we don't just look at, hey, the market's up, the market's down. We want to get a sense for our clients, the whole picture. And part of that whole picture, as it relates to folks as they go to college or are steering into retirement, is these other factors as well. So I think
Right.
our point, and what we're trying to get at, is while the environment around and what's causing the market to change, it's an opportunity. So if you've been riding the high for the last 5 years, 10 years, and haven't really thought that there was a need to see an advisor or get any sort of thoughts on how that will affect your nest egg or your retirement, now could be a good time to have a conversation with somebody that has that. And I would suggest you do that with somebody that's looking at all these things, so you get a big picture on how to steer into it through
more holistic and not just one little aspect of it, right? So, which we have a team of folks that we work with. If Tom and I don't have an expertise in a certain area, then we have a team of folks that are beyond just the two of us that can help. So with like estate planning and taxes and wealth management and all the different aspects of it, we have a broad team that we work with. So we do look at it holistically, and we don't look at one. We're not one trick ponies, right? So and let's talk about like specifically to the market and fourth turning, and let's bring it kind of more specifically to the stock market. Again, not to be doom and gloom, but let's be real here. There's a lot of things that we can look at and be aware of that we don't want to be we don't want to just dismiss, right? And so with everything that's happening in this perfect storm that we brought up in our last video, specifically to the market, what I've been asking my clients is, what if we had another 1929 stock market crash, where the market lost essentially 90% of its value? Excuse me. Market lost about 90% of its value. So for a person who had $100,000, it dropped down to 10.
I think that could happen again. I think it's
it's not impossible, right? And then we've been in the last couple of corrections that we've had in 2009 and back in after the .com bubble burst in 2001 and 9/11. The recovery was fairly quick. It had its high point, crashed down about 40-50%, and then recovered within a couple of years. But in the Great Depression, when the stock market crashed in 1929, it dropped 90%, and it took almost 17, not quite, right in like almost 20 years to recover back. So if that was the case, what we would ask folks to think about is, what would that scenario do to your retirement planning? What would it do to your overall mental health? What would it do for your family legacy? All these different areas. And if that's the case, then there are strategies and tools and planning techniques that you could look to help mitigate or eliminate some of that. So that's what we're asking folks to take a look at, to really feel the feels on that, because it's and we're not predicting like a stock market crash like that. Who knows what it would be? But right now, the Nasdaq's down 29.7 year to date. S&P, even with it being up 1,000 points today, the S&P 500 is still down 17.67% year to date, and the Dow's down just 7.69. So we still have year to date losses, and you can kind of pick sample sizes. So even with a positive rally here today of 1,000 points, it's still down, and we still have lines for fuel in Europe. We still have a lot of geopolitical things. We have high interest rates, 40-year high interest rates. We have inflation, and they're excited because it wasn't in the 8s. It was only in the 7s, right? Like, hey, that's
better
good
than
news.
expected.
But it's still 40-year highs.
With the inflation, I mean, that's something where, with all the other plates that we've talked about spinning, there's how does the dollar currency against the backdrop of other currencies working interchangeably with those? How does that look for the long term? Right now, the dollar's strong, but there's I saw today where maybe it's loosening up a little bit of its strength this week. So
we've already got you got the BRIC countries that are already starting to decide, because part of what's made us so strong is that we're the world reserve currency, as you know. And so, that's another whole video we could do, which maybe we do, because this is important, but we're kind of running up against it a little bit here.
The petrodollar and all these.
The petrodollar relationship with the Middle East, and how oil and the world reserve Bretton Woods agreements and all that. But the BRIC countries, which are Brazil, Russia, India, China, and Saudi Arabia just Saudi Arabia just did, but the S was I'm mind blanking on the original S of BRICS, but let's just make it Saudi Arabia now. And I wish I could edit it, but put it in the comments below, tell me, remind me who it is. But the BRIC countries are basically saying, no, we're not going to use the US dollar. Russia's requiring it for their fuel to convert over to the ruble, their currency. So
Yeah, and all the cash settlements that were going out of SWIFT are going into the Chinese system, and so there's a lot of things that are happening behind the scenes that are the signal is that the United States may not be able to have their fingers in the mix of it as much as that they have in the past, which helped kind of keep status quo.
right,
So just things to consider that we might have to think more as team players in the international space instead of just saying, hey, things are going to go the way that they've always gone because that's the way we
right.
dictate them going. So,
Well, at least since Bretton Woods, right, which was right after World War II. I mean, we've basically been the big, the big kid on the block that gets to tell the little kids, go get the ball when I kick it, kind of thing, right? So,
right.
so we are going to have to be more team players. I totally agree, and those will impact everything that's denominated in dollars. Will then be impacted by it. So one of the things that we've been talking to our clients about on top of all this is diversification. So it's not just stock market diversification or bond market diversification or your 401k portfolio, but also to diversify your tax. Gosh, this is another whole video. I mean, where does the time go? It happened. We got into this stuff and it's super interesting, but to diversify, and some of that might be your tax status on or tax treatment of your different investments. So
Maybe this is the same for you, but I would say more than 80% of my clients have things that, from a pure tax standpoint, there's some things they can do, some strategies that are legal and ethical and everyday planner type stuff you can do. They just haven't done it yet, type of thing, where they're currently, as their taxes are set during the retirement years, they're higher than they need to be. So you can become a little bit more tax efficient. So most folks have their nest eggs in accounts that are not yet taxed, which has a lot of benefits.
Never been taxed,
right?
Like 401ks and IRAs, those have never been taxed. Your 403bs,
having strategies as you pivot into those years to be more tax efficient, it might be worth getting some advice on.
Yeah, because it's not like you can just hold it and kind of just take out what you need to kind of set your tax bracket. The IRS at age 72 will make you start taking out money.
Right.
So you lose control. And so part of the things we talk about is diversify and gain control of when you get taxed. Right.
Yeah.
So
I mean, we're all proud Americans. We want to pay our fair share. It's just, not overpaying if we can avoid it. So
right. Exactly. We'll leave that to the $1.6 billion Powerball winner.
Right. Exactly.
I saw some article about like what you actually get if you take the cash payout versus the annuity payout. It's like you only get half. So it was, and then after tax, it was kind of a fun little exercise. It's like, man, you'd think winning 1.6, you'd end up with more than 300 million.
A measly, yeah.
Yeah, tough problem, right? So. All right, well, let's kind of button it up. We have so much more to talk about and get into in future videos, but we don't want to just preach from on high. We'd love to hear what you'd like to hear about. So if you've got any thoughts or opinions or just some things that you're feeling, share it down in the comments below. We want to have this be interactive and enjoy the feedback. So just let us know.
A lot going on, and we're happy to discuss your concerns with you. If you want to get back together with us, we'd be happy to chat with you.
Look forward to it. Yeah. So enjoy your heat wave back home, and we will do another Prosperity Brothers here soon.
Yeah. Let's do it again. Maybe
Joe Gleason from freezing Arizona.
Tom from balmy Chicagoland.
I don't know how to be cold. All right. Well, thanks for listening, everyone, and we'll check in soon. Take care.